Welcome to the Accountancy Learning AAT sample paper videos. In this video, I'll take you through the Level 3 Financial Accounting Sample Paper 1 Task 1. So Part A, we've got some statements that we need to complete. A credit note received for a prompt payment discount is entered in the... So we've received a credit note for a discount, so we've received a discount, therefore it will go in the discount received daybook. Cash sales are entered in so these are going to be transactions that happen, people pay at the time of the transaction, they're going to go into our cash book. An item of revenue expenditure has been mistakenly classified as capital expenditure. Identify the effect of this error on the following items. Net profit. So the revenue expenditure would be a cost to the business. So that's missing from our accounts, which means our profit is going to be overstated because those costs haven't been taken into account as it's been put into the capital expenditure instead. Non-current assets, again, that will be overstated because it's gone in as capital expenditure, so our non-current assets will be higher than they actually are. Then the final two, we've got current assets and current liabilities. So these have no effect. This mistake has no effect on either of those. Depreciation is an example of the application of so depreciation is spreading the cost of an asset over its useful life. So therefore we're matching the cost to the time periods. So it's on the accruals principle. It's an example of the accruals principle in action. Veer runs a business as a sole trader. The business produces paper and requires a new high-value machine to produce premium paper. Identify which one of the following people would be most suitable to authorise the purchase. So we're looking at most suitable here. So we've got the bank manager. They wouldn't be authorising things on a day-to-day basis. The business's accountant, again, only looks at the accounts on a larger scale and gives advice to the business owner. The employee who will be using the machine is unlikely to have that level of authorization, so it will be Veer, the owner of the business. Maisie is a sole trader with a financial year-end date of the 30th of June. She's not registered for VAT. Purchased a piece of machinery on the 30th of January X3, and then we're given the costs which were paid for by bank transfer. Part B asks us to calculate the value of the new machine to be entered into the accounts and show your answer to the nearest whole pound. So what do we include in the value of the machine? So the value of the machine itself, and then anything that brings it to its location and usable condition. So we need to have it installed. We need to have the floor strengthened in order to be able to use the machine in that room. But we don't necessarily need to redecorate the room in order to use that machine. So we can add these three together to give us £19,286 as the value of the new machine. And now we need to enter it into the machinery account. So this is an asset account. So when you think about your dead click, we're increasing an asset. So therefore it will be on the debit side. It was paid for by bank transfer. So the other side will be the bank. And we put in 19,286. The business purchased a van on the 31st of March 20X3 for 27,500. The policy of depreciating vans is a straight line method at 20%, assuming a residual value of 10% of the purchase price. Depreciation is prorated for every full month that an asset is owned, and it was disposed of on the 1st of February 20X5. So we need to calculate the annual depreciation charge on the van and work to the nearest whole pound. So we're straight line method. So first of all, let's work out a depreciable amount, which is the cost of it less the residual value. So 27,500. Then we will take off 10% of that value to give us our depreciable amount, and we times that by 20%. That's our annual charge. And when you've done that calculation, it's £4,950 per year. Then next we need to calculate the accumulated depreciation on the van before its disposal. And again, we're showing answers to the nearest whole pound. So we know that 4,950 is our annual amount, but it's done prorated on every full month that an asset is owned. So it's bought on the 31st of March. So it's from the 1st of April, X3. It was sold on the 1st of February, X5. So the full month is to the 31st of January, which is 22 months that it's been owned for. So we take our annual depreciation charge, divide it by 12 and multiply it by 22. So the divide by 12 gives us our monthly amount, and then we multiply it by 22 to give us the amount of depreciation in the time period that it was owned. 9,075. Now the van was disposed of as a part exchange on the acquisition of a new vehicle. The list price of the new vehicle was £36,000 and we can ignore VAT. The business received a part exchange allowance of £9,500 and the balance was paid using a bank transfer. We need to complete the disposal account for the disposal of the van, showing the amount to transfer to the statement of profit or loss and to the nearest whole pound. Our first step with disposal is to take it out at cost in the asset account. So it's sitting as a debit, so we will credit vehicles at cost and debit our disposal account. The full value, which was 27,500. Then next we need to take out the accumulated depreciation. So that's sitting as a credit in the accumulated depreciation account. So we would debit that and credit the disposal account. And that was our 9,075 that we've just worked out. Now we need to take into account this 9,500 that we've got on the part exchange. So that's going to be a debit in the vehicle cost account because that's part of the new cost of the new vehicle. And it will be a credit in the disposals account. Now in the exam, these would have auto summed and our debits would be higher than our credits. So our balancing figure, our transfer to the statement of profit or loss will be on the credit side of 8,925. The business sold a van for £10,020. The van had been purchased for £28,500 and the accumulated depreciation at the point of sale was £16,480. The business will record A and we need to decide if it's a gain or loss on this disposal. So to do that, we need to work out what the carrying amount is at the time of disposal. So 28,500 was our original cost, and we'll take off the accumulated depreciation, and that gives us a carrying amount of 12,020. That's how much we would be expecting the van to be worth. We only got 10,020, which means we're going to make a loss of 2,000. The business has a policy to depreciate office equipment at 20% using the diminishing balance method, assuming no residual value. Prior to adjusting for depreciation, an extract of the trial balance is as follows. Now we need to calculate the depreciation which would be charged for the year and what the carrying amount would be following the adjustment for depreciation, now working to 2 decimal places. So because we're working on the diminishing balance method, we need to apply the depreciation percentage on the carrying amount. So let's work that out first of all. So we'll take the accumulated depreciation off of the cost to give us 29,577. Multiply that by the 20%. That now gives us our depreciation value of £5,915.40. Now we take the new carrying amount, then take off the depreciation to give us the new carrying amount now £23,661.60. Depreciation on vehicles for the year has been calculated as £32,840.40p. Complete the journal to account for the depreciation of vehicles and show your answer to 2 decimal places. So depreciation is going to take the depreciation account as an expense to the business, and it's also going to take into account the accumulated depreciation as well for vehicles. So here's our amount that we need to put in. It's an expense to the business. So the debit will be the depreciation expense and the credit will be our accumulated depreciation account. Maisie is reconciling the general ledger to the non-current asset register. She is looking at fixtures and fittings. The balance in the general ledger after accumulated depreciation has been deducted is £72,382. The balance on the non-current asset register for the carrying amount is £65,282. Now we need to identify whether the following statements could explain the discrepancy. So we've got the general ledger as being higher. So always work out which one is higher before you start looking at the statements. So depreciation for the year was omitted from the ledger accounts. So if the depreciation hasn't been put in to the ledger accounts, it means that the balances on the general ledger is going to be higher than what is in the non-current asset register. So yes, that could have caused the discrepancy. VAT was included in the cost of an asset recorded in the non-current asset register. So if VAT had been included, that would have raised the value of that asset, which then means the non-current asset register would be higher than what the general ledger is. In this question, the general ledger is higher, so therefore it wouldn't have been able to have caused the discrepancy. That completes task 1.